War in the Middle East rarely stays confined to the Middle East. Every missile launch, every naval movement, every sanction announcement sends signals through oil markets, shipping routes, and financial systems that connect the entire global economy. Which is why, thousands of kilometers away, Beijing is watching the Israel-Iran conflict very closely. Not because China is directly involved in the fighting, but because the outcome could quietly reshape one of the most important systems sustaining China's economic power: global energy flows. The question is not whether China will intervene in the conflict. The real question is how this war could reshape the energy networks that China depends on, and whether it creates new opportunities or new vulnerabilities for the world's second-largest economy. To understand why, we need to start with a simple reality. China is the largest importer of oil on Earth. Its economy consumes more than 14 million barrels of oil per day, and roughly 3/4 of that supply arrives from abroad. Factories, freight networks, aviation, heavy industry, and petrochemical production all depend on a constant stream of imported energy. That dependence creates a structural vulnerability. And the Middle East sits at the center of it. Saudi Arabia, Iraq, the United Arab Emirates, and Iran collectively represent a massive share of the oil that powers Asian economies. For China, the region is not simply a distant geopolitical arena. It is a critical part of its economic infrastructure. A disruption in Middle Eastern oil flows would ripple directly into Chinese manufacturing costs, transportation prices, and ultimately economic growth. Which is why any conflict involving Iran immediately raises concerns about energy security in Beijing. But the story becomes even more complicated when we look at how those oil shipments actually travel. Much of the region's energy exports move through one of the most strategically sensitive maritime corridors in the world: the Strait of Hormuz. At its narrowest point, this shipping channel is only about 33 kilometers wide. Yet roughly 1/5 of globally traded oil passes through it every single day. If that corridor were disrupted, even temporarily, the shock would travel instantly through global energy markets. Oil prices would surge, shipping insurance costs would rise, and the price of fuel would increase across economies already struggling with inflation pressures. For China, the implications would be immediate. Higher energy prices translate into higher production costs. Higher production costs ripple through export industries. And because China is deeply integrated into global manufacturing supply chains, those costs can eventually reach consumers worldwide. But oil prices are only one part of the equation. Another layer of concern lies in the structure of global trade routes. China's export economy depends on maritime shipping lanes that stretch from East Asia through the Indian Ocean and into the Middle East and Europe. Any military escalation that threatens those corridors could disrupt not only energy imports, but also the outbound trade flows that sustain China's manufacturing sector. In other words, the same conflict affecting oil tankers could also affect container ships carrying electronics, machinery, and consumer goods. And that brings us to a second reason China is paying close attention: the financial system behind energy trade. For decades, most global oil transactions have been priced and settled in US dollars. This arrangement, often described as the petrodollar system, has reinforced the central role of the dollar in global finance. Energy exporters earn dollars. Those dollars are then recycled through global financial markets, sovereign investments, and international banking systems. China has long explored ways to reduce its dependence on that structure, not by dismantling it overnight, but by slowly expanding alternative financial channels. In recent years, some oil transactions between China and certain exporters have been settled in yuan through platforms such as the Shanghai International Energy Exchange. These transactions still represent a small share of global energy trade. Yet they illustrate an important strategic objective. Diversification. If geopolitical tensions disrupt traditional financial systems, countries that have alternative payment channels may have greater flexibility, and conflicts in the Middle East often accelerate these experiments. Sanctions regimes, banking restrictions, and payment barriers force countries to explore different ways of conducting trade. Iran itself has long operated under extensive Western sanctions, which has pushed it to develop alternative financial relationships with countries willing to buy its oil outside traditional frameworks. China has been one of those buyers at various points over the past decade. If you're interested in how power, oil, and money shape the world behind the headlines, consider subscribing to Rise and Ruin, Power of Wealth. Because to understand why China is watching this conflict so closely, we need to look beyond the battlefield and into the structure of global economic competition. Energy security is not just about access to oil. It is also about resilience. Countries want supply networks that can survive disruptions, sanctions, or geopolitical pressure. Over the past 2 decades, China has invested heavily in building that resilience. Strategic petroleum reserves, long-term supply contracts, pipeline infrastructure linking Central Asia to Western China, and maritime investments across ports stretching from Southeast Asia to the Middle East. Many of these projects are connected to the broader Belt and Road Initiative, a network of infrastructure investments designed to strengthen trade and energy connectivity across Eurasia. In theory, diversified supply routes make economies more stable, but they also reveal how deeply global power is tied to geography. The Middle East remains one of the few regions capable of increasing oil production rapidly when global markets tighten, which means any instability there influences global energy prices far beyond the region itself. When oil prices spike, the consequences ripple through financial markets. Inflation expectations shift. Central banks reconsider interest rate policies. Currencies move. Investors adjust portfolios toward energy companies and commodity producers. In other words, a regional war becomes a global economic signal. China must navigate that signal carefully. On one hand, higher oil prices increase costs for Chinese industry. On the other hand, instability among competitors can sometimes shift geopolitical alignments in ways that create new diplomatic opportunities. China has increasingly positioned itself as a diplomatic actor in the Middle East, not as a military power in the region, but as a major economic partner. It imports energy, builds infrastructure, and maintains trade relationships with multiple sides simultaneously. That balancing act becomes more complicated when tensions escalate. Supporting one partner too strongly risks alienating another. Remaining neutral may protect economic interests, but it limits political influence. This delicate positioning is why Beijing's public messaging during regional conflicts often emphasizes stability, ceasefires, and diplomatic dialogue, not simply as moral positions, but as economic priorities, because prolonged instability threatens the systems that sustain global trade. And the deeper we look, the clearer another pattern becomes. Modern geopolitical competition is increasingly shaped by networks rather than formal alliances. Energy pipelines, shipping corridors, financial payment systems, technology supply chains. Each one represents a node in a much larger structure of power. Disrupt one node, and the consequences spread through the network. For China, the Israel-Iran conflict is not just a regional security issue. It is a stress test for that global network. How resilient are energy markets? How stable are shipping routes? How flexible are international payment systems under geopolitical pressure? The answers to those questions will influence not just China's strategy, but the economic calculations of countries across Europe, Asia, and the United States. And there is another layer worth considering: energy transitions. While many economies are investing heavily in renewable energy, oil remains deeply embedded in transportation, aviation, petrochemicals, and heavy industry. Even countries accelerating the shift toward electric vehicles and renewable power still rely heavily on fossil fuels in the present. That means conflicts affecting oil supply can still shape the global economy in profound ways. For China, which is both the largest energy importer and the largest manufacturer of renewable technologies, this creates a complex dual reality. It is simultaneously preparing for a lower carbon future while remaining deeply dependent on existing energy systems. The Middle East sits at the center of that tension, because for the foreseeable future, global oil supply stability remains essential for economic growth. Which brings us back to the original question. Why is China watching the Israel-Iran war so closely? Not because the conflict directly determines China's political future, but because it sits at the intersection of several systems that do. Energy security, trade routes, financial infrastructure, and the delicate balance of geopolitical relationships that support them. Wars today rarely reshape the world through battlefield victories alone. Their deeper impact often emerges through markets, supply chains, and financial systems that quietly absorb the shock. Oil prices adjust. Currencies fluctuate. Shipping routes reroute. Investors reposition capital. Each of these reactions sends signals through the global economy. Signals that policymakers in Beijing and in capitals around the world are constantly interpreting. If this helped you see the bigger picture, take a moment to like the video, share your thoughts in the comments, and subscribe to Rise and Ruin, Power of Wealth for more documentaries on oil, power, and the forces shaping global finance. Because behind every major geopolitical crisis lies a deeper system of incentives, dependencies, and economic structures. And understanding those systems reveals something important about modern power. It rarely moves in straight lines. Instead, it flows through networks of energy, finance, trade, and influence that bind distant regions together. Which means that when conflict erupts in one part of the world, countries thousands of kilometers away may already be calculating the consequences. Quietly, carefully, and very closely.